Hey, folks, this is Greg again from Options Animal. Welcome to the Everyday Trader. What we're going to do today is we're going to talk about a single tip that is going to make you a more successful trader. I'm
Whoa,
joined,
that's a big promise, Greg. That's
but
pretty
I'm
exciting.
joined by Eric. Eric,
Oh,
we're
okay.
going to try to do it today, and let's jump right into what that tip is because a lot of times we spend time on this channel talking about big macro pictures. We talk individual stock stuff. We talk trades. We want to talk today about a little bit of investor psychology and some tools that you can do to help make yourself a better trader. And to me, this tool is understanding your exit points that you're going into at a trade. And I think a lot of investors fail in making this decision before they enter trades. And when they do that, they set themselves up to be ruled by emotion, particularly two emotions, fear and greed. And I know we try to teach people how to do this over at Options Animal, but a lot of times it's just got to be something that's learned through a process that you do yourself and in helping create investor discipline. And Eric, I know you've spent a lot of time studying this. There's some good books we've talked about that are out there that we can maybe recommend. But what are your thoughts on how do you control these two emotions in your
It,
trading?
it's a big one because we're humans. We have behavior, we have biases. We're programmed to work certain ways. We make sometimes decisions that we're not consciously aware of that are, I think, designed to help us from an evolutionary standpoint, but end up harming us, especially in the financial space. There's a lot of good references out there on how we can be our own worst enemies sometimes. But I wanted to really hit on what you said there, and this is there's a lot of things you can do to become a better trader, but I think there's one thing that you can do that above all other things that will make you more successful. And that is being absolutely clear on when you're going to close your trade. And most of you people enter into a trade with no idea of what your plan is. And there's two sides of that plan. Greg said exits. And so there's often multiple things that can happen. I mean, simply, we can think of a stock can go up, down, and sideways. And take stock, for example. Okay, so you're going to buy shares. What is your objective with buying shares? Why are you buying the shares? And you should have a goal of what it is that you're trying to achieve. And for those of you that are familiar with the concept of goals, the goals should be something specific. You've probably heard the term SMART goals. So it should be something that's specific and measurable. So I want to make 20% within a year. So they also should be time bound and realistic too. That those are the letters that go into the word SMART. And that's what I think is the biggest mistake that I see traders doing, is not having a goal on when they're going to close their trade when it does what they want it to happen. But probably more important than that is, what do you do when your trade goes against you? And we
Yeah.
talk about those as secondary exits. I want you to talk a little bit about secondary exits.
Well, the key thing about this secondary exit plan, what to do if I'm wrong, is that it controls fear. And fear is paralyzing in the market. Fear is paralyzing in life, right? I mean, it's a natural emotion we have. It helps us survive, like you were saying, as an evolutionary species, to survive risk. And the problem in the market is that fear causes you to sometimes panic or sometimes freeze and do nothing because of that fear, which ultimately leads to inaction, which ultimately then leads to loss, which then leads to a loss of confidence, or maybe an increase in desperation, which then causes you to make foolish trades trying to make that back up, all while recognizing, if you can take a step back from that, the initial failure was the control of the fear to begin with. And the only way I have found to successfully do that over the tens of thousands, if not hundreds of thousands of trades that I have placed over the last 25 years, the only way I have found to successfully do it is to have it predefined what I'm going to do before I ever enter the trade. So if I go do some research and say, you know what, I like Microsoft's earnings that they just announced yesterday. I know the market didn't necessarily like them this morning, although I think Microsoft just turned green while we've been talking. But I'm just using a current example. Let's just say a theoretical example, but let's say I liked Microsoft's earnings today and I say, I'm going to go put on this trade on Microsoft that's bullish. I need to decide where I'm going to get out if I'm wrong. Because what oftentimes happens is if the market goes the wrong way, we then hang on to it. We don't, and then that trade becomes a long-term investment. And you find things to rationalize yourself to continue in bad trades. And not only are you potentially risking capital and with that loss, you're risking opportunity cost in using that capital that could be working for you somewhere else. But I think the biggest thing you're doing is you're damaging your confidence in your abilities to make new trades going forward. And so, in my opinion, it's okay to lose from time to time. It's okay to have a trade that goes the wrong way. We're all going to have those. But what's more important is to know that you have it defined. This is how much I'm going to lose. That it's X percentage, or better yet, if the trade goes against me, how do I change it to still potentially turn that into a profit? And when I implement that in my trading, I can now approach markets where I don't fear what's coming because I already have it all planned out. And I just try to be systematic in how I approach it. And it's, if X does this, then I do this. And it really makes trading a much more manageable hobby, if you want to call it a hobby. I don't like to call it a hobby. I actually, like to try to treat it like a job. But it becomes more successful and less stressful. And to me, that's the end goal, is not only do you have the ability to make good returns, but you've got the ability to do it with less stress.
Well, there's, I read a lot and have a lot of reference, and we talk about it. I like that you're curious and like to read and seek other information too. And I think I stand on the shoulders of giants on some of the stuff that I'm able to share here. And one of the resources I refer to this book by Van Tharp, and this is from 2007. I don't particularly recommend the book. I think there's two key takeaways in here. And one is it starts off with this parable of the Holy Grail, not to be confused with Monty Python's Holy Grail, but the parable of the Holy Grail is sort of like the Wizard of Oz, that what you need is within you already. You just need to find it and develop the skills and the resources and tools to be able to use what you already have. But the real key takeaway about this book is exactly what we just said, that success, and he goes through a very compelling arguments and of using real data, explaining how traders can make money if they define where they're going to close for a profit, and more importantly, what they're going to do if they lose money, if they're not hitting their goals. So being unemotional about it, because you talked about the emotions. I started to laugh because I remember one of our summits, we were talking about the 3 F's or the 4 F's. So the fear, fight, flight, and apparently there's a couple more F's that are maybe R-rated that go in there. But these base human emotions, and I wanted to, another reference is Daniel Crosby, who's written some fantastic resources. One of my favorite books from him is This Behavioral Investor, and in there he makes the point that you become stupid when you're under stress. And I'm saying that to be a little bit shocking to get your attention, but his point is that objectively you'll lose 17 points off your IQ when you're under stress. So when things are going wrong in the market and your stock is down and you haven't thought through, and you start thinking about things like, am I going to be able to retire? Can I feed my family? Just when you need to be at the top of your game thinking, you literally become less intelligent. So his solution, similar, Van Tharp's solution, is using stop loss orders, which we can talk about why that's not the greatest idea. But if that's all you have for a choice, I think if all you're doing is stock and you don't have the ability to use a collar trade, I guess you have to use that. But Crosby talks about this other tool that you would use, and it lines up perfectly with what we consider as secondary exit, and that is, he calls a pre-mortem. So rather than a post-mortem, and I think post-mortems are great too, you should be evaluating your trades that have gone against you and try to identify where things went wrong, and where could you have changed, um, to, when could you have made an identification to see that there was a trend change, or you should have done something different. And just as a personal note for me, when I find when I use the word hope, if I've said the word hope in my head, that was when I should have followed my exit plan. But the pre-mortem this is based on psychology for people who have anxiety issues, is they imagine what could happen. What are the worst things that could happen here? And what would I do if those things happened? And then being able to play out, can I avoid those things from happening? Or how bad would it be if that happened? And that pre-mortem is, I think you can take that a step further than just identifying what could happen, is what would I do when that happens? And I think that's really the key. We've seen, you talked about hundreds of thousands of trades. I'm no question that, because I know that we've seen tens of thousands of traders, tens of thousands of retail traders. And we see the spectrum of people who are successful and not successful. And I think that the one thing that all of the successful people have, and this applies to everywhere, not just in trading, but anywhere. I don't care if we're talking about golf or a business person or a chef, or you pick anything. Anybody who executes on the top of their game has one thing in common, is they follow a process. And your video that you did last week talking about the 6-step process, I encourage everybody to go back and look at that. And what we're talking about here is step 4, which I think is the most important part of the process. And that is being smart about when you're going to get out and what you're going to do when something goes wrong.
I couldn't help but, the first part of your conversation that you were just talking about, all I could think of was, it's not a matter of migration, it's a matter of weight ratios.
It's a similar,
and then you brought in that you're stupid.
European
Like,
swallow.
Oh,
Coconuts. Okay, so some of you, that's Monty Python and the Holy Grail that we're going back to.
Anyway,
autonomous collective. You're fooling yourself. Go away, you tiny minded tapper of other people's bottoms. Oh, you gotta watch that again. Has you watched that with Junior?
I can't get him to watch it. I don't know why. I'll get him to watch it.
Okay.
He's finally getting old enough that he can start to appreciate British humor. I think that's part of the issue. Anyway, sorry to make us digress. This is a very important part of your trading, and I'm going to add one more piece to it. We're talking about the secondary exit. Part of controlling that emotion is even doing what you're going to do when you're right.
Yeah.
I think another mistake that traders make,
right,
is they jump in and they say, I'm going to go do this trade, and if I'm going to make money. Well, how much money? Because here's a problem. Let me give you a perfect example. This is this week. On Friday, I placed a long straddle on Apple, mostly because I felt like the implied volatility was low. We've got earnings coming up in about a week. And my plan was I was going to ride this trade up to earnings and then sell it before earnings, just with the increase of implied volatility. And I know I'm going into a little wonky stuff for those of you who don't follow options trading, but don't worry, you'll get that. Go back to some of our other videos and you'll find some discussions about implied volatility. But the point I'm trying to make is, I also had as part of my primary plan that if I could close one or two of the legs, either one of the legs, and takes the entire amount of trade off the table, meaning it was $8. That's what I paid to do this trade. It was about $4 per leg is what I did for the trade. And with the move we had on Monday in Apple to the upside, I hit that. In fact, it was even a little bit more than that. I sold my call for $9. So I took an extra dollar off the profit for the entire trade. And now I still have this put option that to me is now a completely paid for trade. It's a free shot in the other direction. So if Apple tanks between now and their earnings date on February 2nd, I now have the ability to make a huge return. But if I had been just going into the trade going, I'm just going to see what it does, I would have watched this straddle go up in value with the move up we had on Monday, to then watch it turn around and come back down in value today, to now actually being less than what it was worth when I entered it on Friday.
And I've heard that before with traders who buy stock, how often I mean, we've had a really bullish market here for quite a while, but a common refrain that I hear among retail traders is, if it just gets back to where I bought it, I'll sell it so I can break even.
Yeah.
All that time you mentioned earlier, you're tying up capital, and it's not just capital, it's your mental and your emotional resources that are, tied up and focused on this trade. Sometimes it makes more sense just to cut bait and go do something else. One other data point I wanted, was it going?
No, I was just going to make one more comment. And then greed can be just as blinding as fear.
Oh, yeah.
So control them both.
Yeah, that's not uncommon for people. My thought is that you unless the trade you're in is the next trade you would do, then close your trade and go do another trade. There's no reason why you can't have multiple trades going on at the same time. I have 4 trades going on Tesla right now. We have earnings after the close. But I was going to make a point, and that is, you should expect that you're wrong. And that just is a little bit of a benchmark. One of my favorite sort of tools when I'm teaching to show people is this resource from CXO Advisory that shows the track record of gurus. So this is their guru grades, and they tracked some people who are very well known. You got Ken Fisher on here, certainly other names that you've seen. Here's Jim Cramer. So Jim being right 46.8% of the time, which is interesting. I don't know if you've seen, there's an inverse Cramer ETF out there.
Yeah.
But a lot of these people who are very well known and respected are really not that good. And if you look at the list over here. So James Dines, he has a track record of being right 50% of the time. Zach's 50% of the time. Bernie Schaefer's just under 50. If you look at S&P 500, these are people who do this professionally, and most of them are worse than the flip of a coin. So what makes you think as a retail trader that you're going to be better? And world class is in the low 60s or the mid 60s. If you can get above 60% accuracy, you're world class in your ability to prognosticate. So you should enter a trade with the expectation that you're going to lose money. And this, how do these people make money? I'm sure that some of them do make money. I'm not sure overall if they do, but I think the important part is recognizing when you're wrong and cutting your losers or having some other trade. And one of the things I like about trading options is that we can adjust our trades to make money in multiple directions. The key is placing that strategy ahead of time. And that's what that 6-step process that you talked about walks through is how to identify the right strategies from the onset and how to know when to follow your exit plans. What do you think?
Well, I think that's some good data for you guys today. Hopefully you will think about this as you're looking at your trades. Think about managing that risk perspective that is a psychological one, not necessarily one that you can identify on a chart, but more one that's in your process. So think about that as you do that. In the meantime, subscribe and like, and we'll see you at the next one.
Yeah, and if you have questions about how would you implement something like this, go ahead and ask them in the comments down below, and we'd love to hear your feedback and see your ideas on this concept.
Thanks, Eric. See you at the next one, man.